What if you could own part of a giant company today? That opportunity exists through something called the stock market. The stock market is where investors buy and sell ownership shares. These ownership shares are commonly known as stocks. A stock represents a small piece of a company. When you buy a stock, you become a partial owner. Even one share gives you ownership rights. The success of the company can benefit shareholders financially. Companies use the stock market to raise money for growth. This money helps fund expansion projects and operations. Investors provide capital in exchange for company ownership. This relationship benefits both businesses and investors. The stock market connects companies with potential investors worldwide. It acts as a marketplace for buying and selling shares. Stock exchanges organize these transactions efficiently. Buyers and sellers meet through these exchanges. Prices change continuously based on supply and demand. High demand usually pushes stock prices higher. Low demand often causes prices to decline. This constant movement creates opportunities and risks. The stock market reflects investor expectations about company performance. Positive expectations generally increase stock values. Negative expectations often reduce market prices. Many factors influence stock price movements. Daily company profits are one important factor. Economic conditions also affect investor decisions. Interest rates can influence stock market performance. Global events may impact markets unexpectedly. News often causes short-term market fluctuations. Understanding these influences helps investors make informed decisions. Companies first enter the market through public offerings. This process is called an initial public offering. An IPO allows the public to buy company shares. After the IPO, shares trade freely on exchanges. Investors can buy or sell at market prices. Popular stock exchanges operate around the world. Millions of transactions occur every trading day. Technology has made investing more accessible than ever. Online platforms allow individuals to invest easily. Small investors now participate alongside large institutions. Institutional investors manage huge amounts of money. These include banks, pension funds, and investment firms. Their activities can influence market trends significantly. Individual investors also contribute to market movements. Every trade affects supply and demand dynamics. Stock ownership can generate returns in multiple ways. One way is through rising share prices. Another way is through dividend payments. Dividends are portions of company profits shared with investors. Not all companies pay dividends regularly. Growth companies often reinvest profits into expansion. Mature companies are more likely to pay dividends. Investors choose stocks based on personal financial goals. Some seek growth, while others prefer stable income. Risk tolerance also influences investment decisions. Higher potential rewards often involve higher risks. Diversification helps reduce investment risk exposure. This means spreading money across multiple investments. Diversification protects against problems in one company. Successful investing requires patience and long-term thinking. Short-term price changes can be unpredictable. Long-term investors focus on business fundamentals. Understanding companies is more important than following hype. Knowledge reduces emotional decision-making during volatility. The stock market rewards discipline over impulsive actions. Learning basics creates a strong investment foundation. Every experienced investor started with simple concepts. Understanding ownership is the first important lesson. Stocks are not lottery tickets, but business ownership pieces. The market provides opportunities for wealth creation over time. However, success requires education and informed decision-making. Smart investors focus on learning before investing money. Knowledge helps manage both opportunities and risks effectively. The stock market plays a major role in modern economies. Now you understand the basic foundation of the stock market. Now we explore how investors actually make money in stocks. Most people enter the market hoping to grow their wealth. Stocks offer multiple ways to generate financial returns. Understanding these methods is essential for every beginner investor. The most common method is capital appreciation. Capital appreciation happens when a stock price rises. Investors buy shares at a lower price first. Later, they sell those shares at a higher price. The difference becomes their profit from the investment. For example, a stock bought at $10 may rise. Selling it at $15 creates a $5 gain. This simple concept drives much stock market investing. However, prices do not always move upward. Stocks can also fall below the purchase price. Selling at a lower price creates a loss. This is one reason investing involves risk. Another way investors earn money is through dividends. Dividends are payments distributed from company profits. Companies share a portion of earnings with shareholders. These payments provide regular income to investors. Dividend amounts vary between different companies. Some companies pay dividends every quarter, others pay annually or choose not to pay at all. Growth-focused businesses often reinvest profits internally. Mature companies are more likely to distribute dividends. Dividend investing is popular among income-focused investors. Many retirees prefer stocks with reliable dividend histories. Reinvesting dividends can accelerate wealth growth significantly. This creates a compounding effect over time. Compounding is one of investing's most powerful principles. Small gains grow larger when repeatedly reinvested. Time strengthens the impact of compounding dramatically. Long-term investors benefit most from this process. Stock prices move according to investor expectations. Strong company performance often attracts more buyers. More buyers generally push prices higher. Weak performance may reduce investor confidence. Reduced confidence often leads to falling stock prices. Earnings reports strongly influence investor decisions. These reports show how much profit a company generates. Higher profits usually improve investor sentiment. Lower profits may create concerns about future growth. Investors study financial statements before buying shares. Understanding company performance reduces unnecessary risk. Revenue growth is another important factor to consider. Growing revenue often signals business expansion opportunities. Market leaders frequently attract long-term investors. Strong brands can maintain competitive advantages for years. Investor psychology also affects stock prices significantly. Fear and greed drive many market movements. Fear can cause investors to sell too quickly. Greed can encourage buying at unrealistic prices. Successful investors control emotions during market fluctuations. Emotional decisions often produce poor investment outcomes. Patience is a valuable skill in stock investing. Wealth creation rarely happens overnight in markets. Consistent investing often beats constant trading activity. Frequent trading increases costs and mistakes. Long-term investing focuses on business growth potential. Short-term speculation focuses mainly on price movement. Beginners often confuse investing with gambling behavior. Real investing requires research and thoughtful analysis. Understanding risk is essential before buying stocks. No investment guarantees profits every time. Even excellent companies experience temporary declines. Market corrections are a normal part of investing. Experienced investors expect occasional downturns. They focus on long-term opportunities instead. Risk management helps protect investment portfolios. Diversification remains one of the best protection strategies. Learning these principles builds confidence over time. Confidence grows through knowledge, not blind optimism. Smart investing combines patience, discipline, and education. These qualities help investors achieve better outcomes. Now you understand how stocks generate returns for investors. Now, we explore why stock markets rise and fall over time. Market movements are influenced by both economics and human psychology. Understanding these cycles helps investors avoid costly mistakes. Stock markets never move upward forever without interruptions. They experience periods of growth and periods of decline. A rising market is called a bull market. Bull markets occur when investor confidence is strong. During bull markets, stock prices generally trend upward. Economic growth often supports these positive market conditions. Companies usually report improving profits during bull markets. Investors become optimistic about future opportunities. This optimism encourages more buying activity. Increased buying pushes stock prices even higher. Bull markets can last for months or even years. Many investors make significant gains during these periods. However, excessive optimism can become dangerous. Investors may start ignoring risks completely. This often leads to overvalued stock prices. Eventually, market conditions begin to change. A declining market is called a bear market. Bear markets occur when prices fall significantly. Investor confidence decreases during these periods. Fear becomes more powerful than optimism. Selling pressure increases across the market. Falling prices create concern among investors. This concern often leads to more selling. The cycle can continue for extended periods. Bear markets are a normal part of investing. Every major market has experienced bear phases. Even the strongest companies may decline temporarily. New investors often panic during market downturns. Emotional reactions can lead to poor decisions. Selling during fear often locks in losses. Experienced investors remain focused on long-term goals. They understand market declines are temporary events. Market psychology plays a major role in price movements. Prices are influenced by emotions as well as fundamentals. Fear and greed are powerful market forces. Greed often appears during strong bull markets. Investors rush to buy because others are profiting. This behavior is known as herd mentality. Many people follow crowds instead of conducting research. Herd behavior can create market bubbles. A bubble occurs when prices rise beyond reasonable value. Eventually, reality catches up with expectations. Bubble collapses often lead to sharp market declines. Fear dominates after excessive optimism disappears. Investors begin selling rapidly to avoid losses. Understanding these emotional cycles is extremely important. Market history repeats similar psychological patterns repeatedly. Economic news can influence market sentiment dramatically. Positive news often boosts investor confidence. Negative news may trigger widespread concern. Interest rate changes also affect market behavior. Lower rates often support stock market growth. Higher rates can reduce investor enthusiasm. Global events sometimes create sudden market volatility. Political changes may influence business expectations. Unexpected crises can create temporary market panic. Long-term investors avoid reacting to every headline. They focus on business fundamentals and future potential. Market volatility creates opportunities for disciplined investors. Lower prices may allow quality stocks to be purchased. Patience often produces better results than emotional reactions. Successful investors understand market cycles are unavoidable. They prepare mentally for both good and bad periods. Risk management becomes especially important during uncertainty. Diversification helps reduce the impact of market declines. Knowledge reduces fear during difficult market conditions. Confidence comes from understanding how markets function. Every bull market eventually faces challenges. Every bear market eventually reaches an end. Markets move in cycles rather than straight lines. Understanding psychology helps investors navigate these cycles wisely. Now you understand bull markets, bear markets, and market psychology. Now we explore one of the most important investing concepts called risk. Every investment carries some level of risk and uncertainty. Risk means the possibility of losing part of your money. Understanding risk helps investors make smarter financial decisions. Many beginners focus only on potential profits. Successful investors pay equal attention to possible losses. Protecting money is just as important as growing it. No stock can guarantee positive returns every year. Even great companies experience temporary declines and challenges. Market conditions can change unexpectedly at any time. Economic slowdowns often affect stock prices negatively. Company-specific problems can also create investment losses. Poor management decisions may reduce business performance. Competition can weaken a company's market position. Unexpected events sometimes impact entire industries. Understanding these possibilities improves investment preparation. One common risk is market risk. Market risk affects nearly all stocks simultaneously. During market crashes, many investments decline together. Another type is company-specific risk. This risk affects individual businesses rather than entire markets. A company may struggle even when markets perform well. Investors must evaluate both types of risk carefully. Risk cannot be eliminated completely from investing. However, it can be managed effectively through smart strategies. Diversification is one of the most powerful risk management tools. Diversification means spreading investments across multiple assets. This reduces dependence on a single company. If one investment performs poorly, others may perform better. Diversification helps balance overall portfolio performance. Many professional investors rely heavily on diversification. It protects portfolios from unexpected business problems. Investing all money into one stock is extremely risky. A single mistake can create significant financial damage. Diversified portfolios reduce this concentration risk substantially. Investors can diversify across different industries. Technology, healthcare, and finance represent different sectors. Each sector responds differently to economic conditions. Diversifying across sectors improves portfolio stability. Geographic diversification is also valuable for investors. Different countries experience unique economic cycles. International exposure reduces dependence on one economy. Another important concept is risk tolerance. Risk tolerance describes how much uncertainty an investor accepts. Every person has a different comfort level with risk. Younger investors often accept higher levels of risk. Older investors may prefer greater stability and preservation. Investment strategies should match personal risk tolerance. Emotional reactions can increase investment risk dramatically. Fear often causes investors to sell during downturns. Greed may encourage buying at inflated prices. Emotional investing frequently produces disappointing results. Discipline helps investors stay focused on long-term goals. Long-term thinking reduces the impact of short-term volatility. Market fluctuations are normal parts of investing. Temporary declines do not always indicate permanent problems. Understanding business fundamentals provides valuable perspective. Research helps investors make informed decisions confidently. Knowledge reduces unnecessary fear during market uncertainty. Setting realistic expectations is also very important. Stock investing is not a guaranteed path to quick wealth building. Wealth usually requires patience and consistency. Risk and reward are closely connected in investing. Higher potential returns often involve greater uncertainty. Investors must balance opportunity with protection carefully. A well-planned strategy improves long-term success chances. Diversification supports stability during changing market conditions. Risk management protects investors from avoidable mistakes. Successful investing focuses on both growth and preservation. Preserving capital creates a foundation for future opportunities. Smart investors prepare for uncertainty before it arrives. Preparation creates confidence during challenging market periods. Understanding risk is essential for every investor. Risk management separates informed investing from reckless speculation. Now you understand how risk and diversification protect investors. Now we explore the difference between trading and investing. Many beginners confuse trading with long-term investing. Trading focuses on short-term price movements and quick profits. Investing focuses on long-term business growth and value creation. Traders buy and sell frequently within short time periods. Investors hold stocks for months, years, or even decades. Trading requires constant attention to market fluctuations. Investing requires patience and long-term thinking. Both approaches exist, but involve very different risks. Trading can generate fast profits, but also fast losses. Investing grows wealth slowly, but more steadily over time. Many beginners enter the market expecting easy money. This unrealistic expectation often leads to financial mistakes. Lack of knowledge is one of the biggest beginner problems. People often buy stocks based on rumors or emotions. Emotional decisions rarely produce consistent financial success. Another common mistake is following crowd behavior blindly. When everyone buys a stock, prices may become inflated. Later corrections can cause sudden losses for late buyers. This is why research is extremely important before investing. Understanding a company is better than following hype. Many investors ignore business fundamentals completely. Fundamentals include earnings revenue and long-term growth potential. Without fundamentals, investing becomes speculation instead. Speculation increases risk and reduces success probability. Another mistake is not having a clear investment plan. A plan defines goals, risk level, and time horizon. Without a plan, decisions become random and inconsistent. Consistency is key to building long-term wealth. Jumping between strategies leads to confusion and losses. Overtrading is another common beginner error. Buying and selling too often increases transaction costs. It also increases emotional stress and decision mistakes. Many successful investors trade very rarely. They focus on long-term company performance instead. Ignoring risk management is a dangerous mistake. Every investment should consider potential downside carefully. Diversification helps reduce exposure to single stock failure. Risk control is more important than chasing high returns. Another mistake is investing money you cannot afford to lose. Emergency funds should always be kept separate. Emotional pressure increases poor decision-making in markets. Patience is often underestimated by new investors. Wealth building takes time and consistent effort. Quick profits are rare and often risky. Many people lose money due to impatience. Selling during panic is another major mistake. Market drops often lead to emotional reactions. Smart investors stay calm during volatility. They understand that downturns are temporary. Another issue is lack of continuous learning. Markets change and require updated knowledge. Stopping learning reduces long-term success chances. Ignoring fees and costs can also reduce profits. Small costs accumulate significantly over time. Tax awareness is also important in investing decisions. Many beginners overlook taxation effects on returns. Real returns depend on net profit after costs. Diversification mistakes also affect portfolio performance. Over-diversification can reduce overall returns. Under-diversification increases risk exposure significantly. Balance is required for effective portfolio management. Emotional discipline separates winners from losers. Successful investors control fear and greed effectively. Market volatility is normal and unavoidable. Understanding this helps prevent panic decisions. Investing is not about predicting, but about preparing. Preparation leads to better long-term outcomes. Knowledge reduces mistakes and increases confidence. Experience improves decision-making over time. Learning from mistakes is part of growth. Consistency in good habits leads to success. Poor habits lead to repeated financial losses. Smart investing combines patience, knowledge, and discipline. Now you understand trading, investing, and common stock market mistakes. Now we reach the final truth about how stock market wealth is created. The stock market is not a shortcut to instant riches. It is a long-term system for building financial growth. Success depends on patience, discipline, and continuous learning. Many beginners fail because they expect quick profits. Real investing rewards those who think in years, not days. Long-term investing allows compounding to work effectively. Compounding means earning returns on previous returns over time. This creates exponential growth when given enough time. The longer you stay invested, the stronger compounding becomes. Time is one of the most powerful forces in investing. Early investors gain a major advantage over late investors. Even small investments can grow significantly over long periods. Consistency matters more than timing the market perfectly. Nobody can predict short-term market movements accurately. Even experts cannot control daily price fluctuations. Successful investors focus on long-term business growth. They invest in companies with strong fundamentals. Strong fundamentals include profits, revenue, and stability. Quality businesses tend to grow over long time periods. Stock prices eventually reflect business performance. Short-term movements may not reflect true value. Patience helps investors ignore unnecessary market noise. Emotional reactions often lead to poor financial decisions. Fear and greed are the biggest enemies of investors. Discipline helps investors stay consistent during volatility. Volatility is a normal part of stock markets. Markets go up and down, but long-term trend matters. History shows markets have grown over long periods. Temporary declines are part of the journey. Smart investors use downturns as opportunities. Lower prices can create better buying opportunities. This requires confidence and research. Knowledge helps investors stay calm during uncertainty. Without knowledge, fear takes control easily. Education is the foundation of successful investing. Learning reduces risk and improves decision-making. Diversification continues to play a key role in safety. Spreading investments protects against unexpected losses. No single stock guarantees success or safety. A balanced portfolio improves stability over time. Risk management ensures survival in changing markets. Wealth is not built by luck, but by strategy. Strategy includes planning research and patience. Investing without strategy often leads to losses. Understanding your goals is extremely important. Different goals require different investment approaches. Some people invest for growth, others for income. Clear goals help guide better financial decisions. Avoiding emotional decisions improves long-term outcomes. Consistency in investing produces strong financial results. Small regular investments can outperform large random ones. Time in the market is more important than timing the market. Financial success comes from disciplined behavior. Wealth building is a gradual process, not an event. The stock market rewards informed and patient investors. It punishes impulsive and emotional behavior. Understanding risk-reward balance is essential. Higher returns always involve some level of risk. Smart investors manage risk instead of avoiding it completely. Real investing focuses on long-term wealth creation. Short-term speculation is closer to gambling. Education separates successful investors from unsuccessful ones. Knowledge builds confidence and reduces fear. Confidence leads to better investment decisions. The stock market is a powerful wealth-building tool, but it must be used with discipline and understanding. Every investor starts as a beginner with basic knowledge. Growth comes through experience, learning, and patience. Mistakes are part of the learning journey. Continuous improvement leads to better financial outcomes. Long-term thinking creates financial freedom opportunities. Financial freedom comes from smart, consistent investing. The stock market rewards those who stay committed. Now you understand the complete basics of the stock market.